Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
All right, it is now 3 p.m. here in New York. So welcome to this afternoon's webinar. Thanks to everyone who is joining us during the special market time during market hours. Today's session will be hosted by Mark Abssy, who will be covering part 2 of ETF Liquidity. It is not what you think it is. For those of you who don't know Mark, he is the Index and ETF Manager for the International Securities Exchange. He is responsible for all phases in the development of innovative tradable products from concept to commercial launch. Prior to joining us here at ISE, Mark held various product management positions and has also worked on the institutional client side as well. And he's just an all-around great guy. So without further ado, we're going to go ahead and turn it over to you, Mark.
Okay, thanks. Thanks, Katrina. So I'm just going to initiate sharing of my Excel screen. And Katrina, this is what everyone's seeing now?
Yep, we can see your spreadsheet right now.
Okay, great. So those of you who participated in the first ETF Liquidity webinar I gave a little while ago, this might seem familiar. It is. It's exactly the same sheet. But what I'm going to do is quickly review what we went through in kind of part 1 of this, and then talk about other aspects of liquidity, specifically what happens with international ETFs, global ETFs, and how those trade, what that liquidity looks like, and kind of a little bit of the mechanics of how the creation redemption process works there. All right, so in this sheet here, as you can see, we have 2 products. I've just put them in by their tickers. First is PHO, which is the Power Shares Water ETF. The second is FIW, which is the First Trust. It's actually the First Trust ISE Water Index Fund. As you could probably tell, we maintain the index, which is the underlier for the First Trust product. So these are 2 products in the water sector of the exchange-traded fund marketplace. Now you can see here right off the bat that at a first glance, PHO with $870 million seems to dwarf, in fact, does dwarf FIW. You can again look down where I'm highlighting here in the volume, the current day volume, roughly 140,000 shares versus the 28,000 traded for FIW. Most people, when they are looking for exposure to a segment of the market, will look essentially at these 2 numbers, or maybe they might take some kind of an ADV number. In this case, we have the 3-month daily average volume, and we see again that PHO trades a lot more than FIW. So kind of a top-line view, somebody would look at these numbers and say, well, geez, of course, PHO, it has more assets, they must be doing something right, and wow, look at this liquidity. And they may even look down here at the spread, at the bid-ask spread of the 2 funds, and say, wow, PHO's 3 cents wide and FIW's 7 cents wide. I definitely want to make this trade in PHW, in PHO, because I'm going to get a better spread, and I know I'm going to get filled, and also when I want to exit the fund, I know that there's liquidity there that I'm going to be able to exit the fund. And so on that kind of top level, people would look at those 3 numbers perhaps and say, okay, that's it, I'm going to drop the ticket for PHO. And it doesn't matter if it could be an institutional guy dropping. In this case, my model here has a $1 million ticket. It could be someone saying, I just want to pick up 100 shares. But they will look at those numbers and they will say, that's where I want to be. It's more liquid, and so that's where my ticket is being dropped. That's where I'm going to make the trade. Now, where it gets interesting is, when you stop and think a little bit about, well, what is an ETF, right? It's when you buy shares in an ETF, you are buying ownership in a basket of, in this case, equities. Nowadays, of course, it could be anything from oil futures to corn futures to physical commodities of any and many stripes. So in this case, though, we're talking about equities. So you're buying basically a share. You're buying ownership in part of a portfolio of securities. And what a lot of people don't realize is that while the top-line liquidity of the fund, of the ETF itself, certainly is good, it gives you a good idea or indicator as to how well or how followed the ETF is in terms of how much assets it has, and currently are the markets tight or wide. Those are good indicators, certainly. But for an exchange traded fund, they become a little less important than they would for an equity, an operating company shares. And so what I'm going to do, I'm just going to switch pages here and go to this page here is basically a pricing model for the basket, what we call the basket, which is the underlying basket for FIW. Now, when people talk about the creation redemption process, what generally happens is that as trades come in, the market maker is kind of working his book, and when there's an imbalance, when there's, say, more demand than there is actual supply of shares, the market maker will go out to the market and actually put together this basket. In fact, if you were to look at a market maker's trading screen, it would look something very similar to this, where you would have the name of the holding, you would have the weight of that holding in the basket, and then there would be some other things here. What are the bid asks, what kind of spread is this, etc. And they would go out and basically put together a basket trade. Now, creation units are generally done in lots of 50,000 shares of ETF. So what ends up happening is that, in this case, if I look at FIW, the last price here I have is 1982, and if you'll see me, I'll flip back to this other page here. This line here where it says basket size, 50,000 shares of FIW is roughly the equivalent of $991,000. So they will take that amount of money, roughly $1 million, and allocate it per the stated weights, and these weights are stated every morning. There are files that are issued by the issuers. This information is also available on their website every day, and it's updated. And they will take these weights and then create basically the basket trade. They will take that $991,000 and allocate it out among the names, and then buy that basket. Once they've purchased the basket, they perform what's called an in-kind delivery to the fund issuer. So they will take all these shares in these weights, deliver them to, in this case, First Trust, and First Trust will say, thank you for the basket. Here are 50,000 shares of FIW. And they've just now increased liquidity in the fund. They've actually increased a couple of things in the fund, but as far as their book goes, they are now able to fill all those buy orders because they have these extra shares of the fund. Okay. Now, again, when you look at this page, you're looking at these names. There's 35 of them. We have all the weights, and what's kind of interesting here is if you look over in column I that I've highlighted here, these are the spreads of these individual components, and you'll notice that some of them are pretty tight, right? We have Nalco here at a penny to 2 pennies. We have some other names here. Lindsay Corp looks like it's about 12 cents wide. Some of the others, again, a penny, 3 pennies, etc. One of the things which is interesting, and what I would tell people is that, for instance, in a name like Lindsay, or there's another name down here, Flowserve, which currently is at about 15 cents wide. I've highlighted it here. People look at the markets for things, and they say, gee, that thing's trading really wide. And really wide is a relative term, right? SPY is always going to trade at a penny. If it ever traded outside of a penny these days, people would say, oh, what happened? Something's wrong here. But some of these names, they're smaller names, they're maybe not as followed, and they will trade a dime wide, 15 cents wide, etc. And what's interesting, in fact, even as I've been talking, we see here that Flowserve, I don't know if you've been noticing, but it's gone from 15 cents wide, it's now about a nickel, right? 3 cents, 2 cents, you see it flicker around. What I always tell people is that when you look at the bid-ask spread of anything, that's what the market maker, that's what they want, right? They want to ask. They want you to lift that offer and buy at the highest price. If there's an appreciable amount of spread in a name, you know, use limit orders. You gotta trade with limit orders, because if there's 15 or 20 cents, there's no sense in you just lifting that offer. If something's 20 cents wide, put in a limit offer at 15 cents wide, right? The bid ask here is 83.25 by 83.35. If I were going to trade that, you know, you can't always just go and take the midpoint, because that really, I mean, the market maker has to be able to make something on the trade. So if you go a little bit above midpoint, maybe if it's a 10-cent spread, maybe you come in 3 cents. You know, that's trade that'll get printed. Again, you got to leave a little something on the table for the market maker. But as you'll see, right now, like back in Flowserve, we're back out to a dime, 15 cents wide, 17 cents wide. I guarantee you, what just happened there is that somebody sent in a limit order. Somebody sent in an order, and the quotes came in, they filled the order, and then they went right back out again, right? So that's kind of my little sermon on limit orders. And certainly, if anything, you know, last May taught us is that we want to be trading with limit orders regardless. Okay. So at this point now, we have our basket, we have the weights, and we have these spreads. And this is where it gets interesting, because just flipping back to this first page now, when we look here and we see that PHO is 2 cents wide, FIW is 7 cents wide. Now, if you look at the line below here, this average basket spread line, you see that, and I just have the difference of these off in the corner here, but the difference is maybe, I don't know, a penny, maybe a penny, even less. Right now we're out to you know, hundredths of a cent. What's interesting to me is that these numbers are pretty much the same. And so when you take an aggregate, all the trading that's going to occur in these names, it's actually pretty interesting, because a lot of people will say, well, geez, I'm only putting in 200 shares, I'm only putting in 1,000 shares, I'm putting in, you know, whatever their trade is. I don't need a creation basket. I just want to see what's on the book. And again, they'll go back and look at how many shares are traded today and what's the spread, and they're confident that they'll get filled at that spread, you know, in, say, PHO, which is a larger and on the surface a more liquid product. Now, what I like about this kind of analysis is that when you really look at it, and it's tough to tell because today they are more tightly paired. Usually, believe it or not, FIW is actually a much more tightly priced basket, and you see a more appreciable difference in terms of spread between baskets. But you know, you look at the spread between PHO and FIW right now at the fund level, it's 6 cents, right? It's a half penny at the basket level. So even if, you know, you're putting in a trade and you think, well, you know, I'm going to go with the more liquid product, that more liquid product might not be the one you think it is. And even still, the liquidity certainly in this case is comparable. So as the market maker gets all those 200 lots, 1,000 lots, 40 lots, whatever it is, they're aggregating that up, they're putting it up on their book, and they're saying, gee, I need to go out and make a creation unit. And that's basically what happens. They're not going out and dealing with the 7-cent spread at the ETF level. They are going out and they're trading the basket, right? So it's kind of a roundabout way of saying essentially, you know, when you're looking at an exchange traded fund and you're looking to buy, certainly when you place your order, you want to be conscious of what that bid-ask spread is. You want to trade with a limit order, and you want to trade smartly. But if you're looking between a couple or even 3 products, and you're really trading on the basis of how big they are and what that spread is, this type of analysis is difficult to do because people generally don't have access to this kind of information. You probably could set up a screen in Google Finance or Yahoo Finance to just follow that fund. But really what you want to do is kind of step away from the screen a little, step away from the liquidity, and look at the funds themselves. Look at their returns. Look at what kind of exposure the fund is looking to give you, and determine whether that's what you want to do, that's what you want to own, and that's what you want to have in your portfolio. Now, if you're sitting there day trading something, then forget what I just said, and go with the liquidity. But if you're truly looking to invest in these products, and your holding period is mid to near term, and go for the one which is a better fit for your portfolio, and don't worry about, oh, this is 2 cents tighter or whatever it is. You'll get filled. I mean, if I look at this here, right, this is a $1 million trade, which would basically mean that I would be buying a creation unit. If you look here at shares ticket size, that's a 50,000 share trade in FIW, a 62,000 share trade in PHO, right? Whoever's going to take that trade for you is not going to just necessarily match it off the book. They're probably going to go out and put together a creation unit. If I change this to a $10 million trade, right, it's basically the same kind of a thing, right? At these share levels, that's 10 creation units for FIW. It's 12 and change for PHO, right? And market makers are not necessarily going to go and sweep the book because it doesn't make sense for them to do that. It's easier and cheaper for them to just go out and trade the basket, all right? So that in a nutshell is my recap of what we covered before. And so now I'm going to switch a little and start talking about international products. All right. Now I don't know if you all are familiar with this particular product. The ticker is BIC, BICK. This is ISE and First Trust take on the popular BRIC strategy. And what we've done is we've substituted South Korea, for Russia. So it's Brazil, India, China, and South Korea. And the India and China part, because of kind of market access and capital flow restrictions in India and China, the India portion of the portfolio is actually filled by ADRs and GDRs. The Chinese portion of the portfolio is generally filled by what are called H shares, meaning that they are listed to trade in Hong Kong, and ADRs or GDRs. A shares are a whole other deal, and I certainly could talk to people about those if they wanted to, if they had questions later. So when we look at BIC, currently the fund is about $45 to $46 million. This basket size, again, is $1.2 million for a basket. And we look down here and we say that if I had $1 million to trade, gee, that's kind of a lot. When you look at that 423%, and you would think, gee, who would ever make a trade in size for this fund, right? But again, these are folks that are, well, ETFs trade like stocks. You got to remember that they're not stocks, and unlike a stock, unlike an operating company stock, just because that fund trades on average, say 29 or 30,000 shares a day with a 3-month ADV, that number, frankly, is almost meaningless. What you really need to look at is the line below here, right? This basket percentage ADV, right? And the basket percentage ADV means if I take all the components of this big product and I am flowing $1 million through the fund, and I allocate out that $1 million to each of the components, right? On average, it's just 7 basis points of ADV, right? So at the fund level, this fund, I would say, is not super liquid. Some people would say it isn't liquid at all. I would say it's not super liquid. But when you talk about the basket, that basket is extremely liquid, right? And in fact, even last October, last year around this time, there was an investor who decided to make what turned out to be kind of a midterm bet on VIC, and it was kind of crazy because we saw this trade come over, and the trade was for, I think, 1.2 million shares, and it was just that one chunk. Now, I'm going to talk a little bit about the mechanics of how that happened in the background, in a bit, but I mean that was a huge trade. But you know what? The liquidity of the fund itself, the liquidity of the shares of the ETF, had nothing to do with that trade, and in no way played into anyone's ability to put that trade on. All right? It's all comes down to the components, the underlying components, and the liquidity of those components. Okay?
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.